Greetings traders, and welcome back to another survival guide. Chris here, bringing you some more information. Today we're going to talk about what it means to mark something to market. It is a process by which all of us as retail traders experience at one point or another, so it's important to understand what in the world it is. This is something that will add to your bank of knowledge. It may not be a technical analysis indicator, but the more knowledge you have, the better the chance you have at passing the Gauntlet Mini, so listen up. And if you like the video, guys, please do me a favor and click that like and subscribe button down below, because it allows me to keep coming out with this educational content for all of you out there. But without further ado, let's get going, folks. The turbulent and volatile markets that we as traders navigate today present us with lots of different challenges. Among them, the main ones tend to be increasing the complexity of ensuring a fair representation of our portfolio's value. So is the case with the pricing of separate constituents, including shares, futures contracts, and other securities on the market side of things. To overcome this, the financial world has adopted what is called a mark-to-market methodology. This is also known as MTM. We're going to talk about how marking to market affects us as retail traders, as well as the institutional derivative traders. By the definition, mark-to-market is a method of measuring values subject to periodic fluctuations to provide a fair representation of the current state of the asset or entity. So today, mark-to-market is used in investing, which means stocks, futures contracts, mutual funds, accounting assets and liabilities, the list goes on and on. In trading, it is used to better reflect a security, account, or a portfolio's current market value instead of its book value. To do that, it adjusts the value of the instrument or the account to the current volatility and market performance. The goal is to provide a fairer representation of the portfolio's health. For example, if the recent market developments drag the account below the required level, the trader receives a margin call. In the context of mutual funds, mark-to-market is used on a daily basis to help provide a better idea of the fund's net asset value. For accounting purposes, mark-to-market helps present a more transparent representation of the current value of the company's assets and liabilities based on today's market conditions. The mark-to-market methodology was first introduced in the 1800s in the United States. At the time, it was the usual practice of bookkeepers to use a mark-to-market strategy. However, after a while, many started attributing the prerequisites for the Great Depression, the instability of the economic system, as well as the bank's mass collapse due to the mark-to-market strategy. In 1938, its use was discontinued, but in the 1980s, it was reintroduced. This time, it wasn't a smooth ride. The growing popularity of the methodology also exposed its loopholes. As many corporations and banks started applying mark-to-market over time, they found weaknesses in its design that could be exploited for accounting frauds, mainly in situations where the real day-to-day asset value couldn't be determined objectively, like in the case of crude oil futures, where the price of the instrument is derived from another commodity. The epitome of a wrongful application of mark-to-market accounting principles, for example, was the biggest scandal in corporate history, the fall of Enron. After that case, regulators introduced changes in the mark-to-market method, including implementing stricter accounting standards, more explicit financial reporting, independent auditing, and more robust internal controls in an attempt to make the mark-to-market more digestible and more enforceable. Today, mark-to-market is an officially recognized and widely adopted methodology for tracking the fair and actual value of accounts and an entity or individual's current financial situation. You might be wondering if there is so much difficulty behind making sure mark-to-market works properly. Well, what is the need behind it? The need for a method like mark-to-market is mainly to prevent market manipulations from happening. Alternatively, it's used to ensure maximum transparency by representing fairly the real value of an asset or account or the financial situation of a company at any point in time. If we go back a few steps, we could say that the main issue with market information is its relevance. Market participants often rely on outdated and historical data to make evaluations or predictions for the current or for a future period. During times with high volatility or market dynamics like the ones that we've been going through the last 2 decades, it is crucial that the information is adequate and fresh. That is why mark-to-market was introduced as an alternative to the popular historical cost accounting methodology, upon which the asset's value was based on its original purchase cost. Understandably, this type of evaluation can provide a fair representation of the subject's current state. Alternatively, it can't accurately calculate what it costs today because the information is outdated and irrelevant to the current market environment. However, if we focus on just one particular reason why mark-to-market is needed, let it be this: to prevent the accumulation of excessive risk for the specific entity, trading account, or portfolio. Once again, that is to prevent the accumulation of excessive risk for the specific entity, trading account, or portfolio. By having access to fair and accurate information about the state of an asset or an entity, market participants can better predict its future trajectory. Mark-to-market works differently based on its use case, so let's talk about a few different examples. In the financial industry, there is always the default risk. Once a default occurs, the loan must be classified as a non-performing asset or as bad debt. The company has to establish a separate account that marks down the value of its assets. Mark-to-market helps do that fairly and accurately. In the context of companies selling goods and offering promotions or discounts to collect accounts receivable quickly, the mark-to-market is required to record both a credit to the sales revenue and debit to the accounts receivables. The values are based on the estimated number of customers likely to take advantage of the discount. In personal accounting practices, the market value of an asset is considered equal to its replacement cost. For example, the insurance on your home or vehicle usually includes the value it would need to be rebuilt or repaired. When it comes to securities, the mark-to-market methodology requires fair value instead of book value. So, for example, the stocks in your brokerage account are marked to market at the end of each day. The case is quite similar to futures contracts and mutual funds, where the value is calculated with the closing bell. Let's assume that you, watching this video right now, is a futures trader and you are going through the process of making your first deposit with your preferred exchange. The deposited funds are used as a margin or a protection for the exchange against potential losses. Think of the margin as a threshold that you should not fall below. At the end of each day, with exchanges like the CME, which does it even twice per day, the futures contracts in your portfolio are marked to their present market value, which is called mark-to-market. If the market developments were favorable, you would be on the winning side. Thus, your account's value would increase as the exchange pays you the profits. On the other hand, if your futures contracts have dropped in value, you would be suffering losses, and the exchange would be charging your account with the deposited margin. If the loss is severe and your account's value dives below the minimum margin requirement, you will receive a margin call. The margin call is the exchange urging you to deposit additional funds to cover the minimum capital requirement, otherwise you default. With this graph, this shows a practical example of how mark-to-market is applied within futures contracts. As with any other instrument, trading futures contracts requires two sides. It requires a buyer and a seller. If the price of the contract goes up at the end of the day, the buyer's account value increases while the one of the short account decreases, and vice versa. So let's say that you are interested in trading wheat and you want to hedge against falling prices of the underlying commodity. You decide to sell 5 contracts, where one contract equals 5,000 bushels, and the current price we'll say is $4. The trade will be equal to, then, $100,000 as it is opened. As you can see, each fall in the value of the wheat futures contract results in an increase in your account balance and vice versa when it goes the other way. The mark-to-market calculation process continues until the expiration date of the futures contract or until you decide to close your position. But futures trading doesn't only happen on traditional exchanges. Institutions and large-scale investors prefer trading derivatives OTC. This is over the counter. However, the case with over over-the-counter derivatives trading is a little bit more complicated. On these markets, the price isn't regulated by the trading venue, but it's instead negotiated between the buyers and sellers. What that means is you can't objectively determine or get the market price immediately. Besides, the price should also include quantification of default, which is also known as non-performance risk. To better navigate this type of market, participants usually use sophisticated computer models that can provide relative pricing information that, more often than not, is close to the price that they will ultimately be paying in the end. In a nutshell, with futures trading, mark-to-market is used to eliminate the credit risk. However, to be applied adequately, it requires the involvement of exchanges or institutional investors trading OTC, since only they can afford the use of the necessary sophisticated monitoring systems. Like any other metric or methodology in the financial world, marking to market isn't flawless. While it helps overcome some issues, it does fall short on some other areas. So let's first cover the advantages. On the pro side of things, marking to market reflects the actual value of an asset. The value for the asset is based on the current market environment, which makes it genuine and a good representation of what's going on. It doesn't rely on history or any data that might not be relevant to the current situation and factors that might affect the value of the account or assets. Another positive side of marking to market is it reduces the levels of risk within the portfolio or the entity. Mark to market can serve as a real-time warning system for default or insolvency risk. It can alert whether the current state of the company's portfolio is good enough to justify investments or predict future performance and exposure to unfavorable market conditions. And another pro is the fact that it's beneficial for every side that is adopting it. Mark to market brings advantages on a micro and a macro level. Brokers, for example, can keep track of account balances of their clients and prevent defaults. On the other hand, investors can take advantage of margin trading, which is way easier to monitor and control than before introducing the mark-to-market methodology. With banks, businesses selling goods, financial organizations, auditors, and regulators, the mark-to-market methodology provides a unified procedure to keep track of the current state of the entities and their financial health that they're currently adopting or currently trading. On the other side of the coin, some cons that we should be aware of. The first one is going to be that it can be inaccurate during volatile periods. Volatility tends to throw pricing mechanics out of bounds. The bigger and more fluctuations, the more distorted and unstable the portfolio or the price of an asset's value is, the more unreliable it can be. Another con is that it can't contextualize information. Although this isn't necessarily a substantial disadvantage, the truth is mark-to-market can't tell how the price at the closing bell was formed. For example, it fails to reveal whether there was a significant and sudden influx of buyers and sellers, and what changes in that short period of time throughout the trading session is something that is going to be hard for the mark-to-market to ever differentiate, and it really can't. So it has a difficult time contextualizing the information as it finally closes off. And then finally, another con could be that the momentum dependency that can harm valuations during economic distresses is something that can be attributed to the mark-to-market methodology. Companies that are forced to calculate selling prices for their assets, like banks with bad loans triggering insolvency procedures, for example, during these economic downturns or low liquidity or market uncertainty periods where they might expect unfavorable valuations, this can make it a bit more difficult during these situations. So, in summary, mark-to-market is something that is meant to solve problems that existed before the mark-to-market methodology. It's not anything that's going to be considered completely airtight and completely perfect. However, the general consensus is that we are much better off on both sides of the coin, meaning both retail as well as institutional traders, with the mark-to-market methodology in place than we are without it. It doesn't mean that it'll be around forever, because if ultimately someone does come up with an idea that is better in every single way than mark-to-market, well then I'm sure it will be adopted. But until then, at least now you know exactly what mark-to-market is, where it came from, and how it works. Until next time, folks, I wish you the best of luck in the markets. Happy trading, happy hunting. I will see you soon. Over and out. Bzz.